U.S. economy. The Federal tries to predict politics. Trade negotiations between the U.S. and China. The Federal chairman said, "We are closely monitoring the implications of these developments for the U.S. economic outlook and, as always, we will act as appropriate to sustain the expansion." After the Federal spent the past 3.5 years normalizing interest rates after the vast monetary stimulus of the post-crisis decade, Mr. Powell, who has been in the job since last February, was pointing to a possible reverse of course. The implicit admission that interest rates could be cut set the scene for a particularly meaningful Federal meeting next Tuesday and Wednesday, during which officials will have to weigh the impact of the trade war with China on the U.S. economy and guide the markets towards their next move. Investors have been increasingly betting that Mr. Powell would press ahead with a rate cut this year, although expectations of a swift move ebbed on Friday on better economic news in the retail sector. While the U.S. economy is still growing at a relatively strong pace, with unemployment at record lows, Donald Trump's escalating trade wars have heightened concerns about a looming downturn. The Federal is trying to guess how far the standoff between the U.S. and China, and Mr. Trump's other aggressive trade actions including threatened tariffs on Mexico, will spill over into the wider economy. Further complicating the Fed's calculations are the frequent attacks by Mr. Trump on the central bank and regular appeals to keep the economy well-juiced as he heads into his 2020 re-election campaign. They make a big mistake. They raised interest rates far too fast, Mr. Trump told CNBC on Monday in one of his sharpest diatribes yet about the Federal. "It's more than just Jay Powell. We have people on the Federal that really weren't, you know. They're not my people. If the Federal were to cut rates, it would be an insurance policy to keep ahead of the significant dislocation from the trade wars," says Sarah Bloom Raskin, the former Federal governor and deputy Treasury Secretary under Barack Obama and now a professor at Duke University. "But if they leave markets and people in the economy with the idea that they caved to White House pressure, they really run the risk of harming their credibility." With all of these countervailing forces at play, most economists are now expecting the U.S. Central Bank to keep interest rates on hold next week, though they could modify the language in their statement to highlight the risks to the outlook from the trade war and shifts in economic data. However, Fed officials will offer a major indication of whether they intend to ease policy later in the year, as early as July, in the economic projections they release alongside their policy statement after the meeting. The forecasts include the so-called dot plot graphic that maps Federal officials' individual interest rate expectations. The dot plot doesn't give them a lot of room for ambiguity, says David Wessel, director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution in Washington. "People will look at the dots and the dots will either show the rate cut or they won't. Either way, Mr. Powell will have to explain that." The move towards monetary easing in the coming months would be particularly striking because just a year ago, after Mr. Powell took office, the Federal had been proceeding comfortably with a series of interest rate rises to fully normalize policy in the hope it would give it more breathing room to tackle the next downturn. Rates had fallen to near zero after the financial crisis, and the Federal added more firepower to its monetary stimulus by proceeding with 3 rounds of bond purchases, known as quantitative easing, to sustain the recovery. Under Janet Yellen, Mr. Powell's predecessor, the Federal began to raise rates, although at 2.25 to 2.5%. They are still less than half of their level in September 2007. Last December, the Federal put the plans for further tightening on hold, in what was described as Mr. Powell's pivot towards a more patient approach to interest rate hikes, after equity markets dropped sharply. Yet as recently as March, Federal officials were still expecting to resume rate rises in 2020, according to the dot plots. Federal officials are not, however, looking at the current situation through the lens of 2007, which would spook markets by signaling a looming recession, but through the frame of the 1990s. Alan Greenspan, then chair, cut rates in 2 cycles, first in 1995 and then in 1998 during the Asian financial crisis, to help sustain the U.S. expansion that took place under Bill Clinton. In past episodes, in the 1990s, we did have insurance cuts by the Federal. Richard Clarida, the Federal Vice Chairman, told CNBC earlier this month. That has been in the monetary policy toolkit in the past. The main factor that has soured the U.S. outlook in recent months has been the escalation in trade tensions between the U.S. and major trading partners. In early May, talks between Washington and Beijing to end their trade dispute unraveled, leading to escalating tariffs on billions of dollars worth of goods crossing the Pacific Ocean every day. Meanwhile, the Trump administration has threatened to slash tariffs on Mexico for failing to curb immigration, and is still considering levies on auto imports from the EU and Japan. Trade is the most obvious and most important risk to the U.S. economy and the world economy, says Joseph Gagnon, the senior fellow at the Peterson Institute for International Economics in Washington. What the Federal is wondering is, if business gets worried and they cut back on investment and spending because they fear it could get even worse. But predicting the course of U.S. trade policy and its effects on the economy under such an impulsive president as Mr. Trump is exceedingly difficult. Frederic Mishkin, the former federal governor and a professor at Columbia University, says the Federal needs to be cautious about changing course because the politics are so unpredictable. It may just be bluster and it may go away if we get a reasonable accommodation with the Chinese, he says. You don't want to be in a situation where you start lowering rates and then have to raise them shortly thereafter. Wall Street is watching closely. Jamie Dimon, chief executive of J.P. Morgan Chase, this week said he hoped the Federal would make the right decision based on the data, adding that big cuts would be a bad sign. If they are doing a 50 to 75 basis point rate cut, that means that the real economy is getting worse, which is not good. Yet the White House continues to pile on the pressure for the earliest possible easing. Far be it for me to suggest it would be great if the FOMC Federal Open Market Committee cut its target rate at the June meeting, Larry Kudlow, director of the National Economic Council, said on Thursday. The Federal would bristle at the notion that it could be influenced by Mr. Trump's haranguing. But one of its big challenges is that incoming economic data has not offered a crystal-clear case for a particular course of action. Growth in gross domestic product of 3.1% in the first quarter has given way to expectations collected by the Atlanta Federal of 2.1% growth in the second quarter. Yet forecasters are not predicting that the U.S. is sliding towards a recession. There has been some weakening in manufacturing and consumer sentiment indicators, while jobs figures showed a slowdown in hiring. But retail sales data released on Friday suggested that consumer spending remained solid. One of the biggest factors that could tilt the Federal towards rate cuts is that inflation has remained subdued. The core personal consumption expenditures index grew by 1.6% on a year-on-year basis in April, well below the central bank's 2% target. While some Fed officials see stubbornly low inflation as a fundamental challenge that should be tackled head-on with rate cuts, others see it as a more transitory factor, and certainly not sufficient to justify monetary easing. Yet some economists warn that Mr. Powell cannot afford to be excessively patient either, and nipping any downturn in the bud is even more crucial for the Federal now because low post-crisis rates give it less space to ease monetary policy in the future. If Mr. Powell wanted to argue that easing should come sooner, one of the arguments that he could make is that if you're at 2.5% on the federal funds rate, you want to get ahead of the slowdown. You don't wait for it to get here, says Mr. Wessel. If Mr. Trump and Xi Jinping, the Chinese president, emerge from the G20 summit in Japan this month with no deal on trade, or not even any signs of a new truce, that might just clinch it for Mr. Powell. It's always hard to predict the economy, he says. It usually isn't this hard to predict the politicians.